Apple not being a monopoly really kind of had me wondering, what is the opposite of a monopoly? Is it a polypoly? Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of September 13th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. This week in the market was a pretty rough one. This is what we've been expecting in September, with basically 5 straight days of losses. There was some data coming out towards the end of the week especially that was indicating that producers of products are paying a lot more than expected, than usual. The entire supply chain has been thrown off for a really long time, and purchasers are paying for that in the end with higher goods prices, which is what we're seeing on the inflation side of things. So this is just numbers coming out that are backing up what we already know. That was the big reason for the market sell-off this week. Now the media is going to go ahead and say it's COVID, Delta variant stuff, whatever. But I think people are just starting to realize how expensive doing business is right now with current prices as they are. And there's just a lot of trepidation, a lot of fear. All of the major indices did fall much lower this week, so there's no point in singling out a bright spot or a particularly negative spot. If you're an index investor, you lost money this week. Sometimes it happens. Now, a little personal note about the channel. This week, I don't know how many videos I'll be able to put out, maybe just this one or maybe one other short one. I am getting my first injection of the COVID vaccine this week, so depending on how my body reacts to that, I might need a day or two to rest and recover. I think I'm going to be getting the Pfizer vaccine. Now, I definitely have some confidence in Pfizer's COVID vaccine. Not only has Pfizer's COVID vaccine gotten the FDA approval, but also Pfizer makes Viagra. If Pfizer can raise the dead, I'm sure it can help protect the living. Let's get started with the news. Now, the first news story this week is actually a first. Now, this isn't the biggest news story by any means, but this is the first time I have ever seen organized crime being listed as a reason for decreased profits on a company's earnings report. Last week, Kroger reported their earnings, and the CEO said organized crime and supply chain issues compressed their margins. McMullen told CNBC that half the margin decline came as a result of disruptions in Kroger's supply chain, which drove up costs. The other half came from a rise of stolen products fueled by an increased prevalence of organized crime. McMullen said shoplifting by organized crime has become more prevalent in the past year or two. He added that he's been working with other retailers and law enforcement authorities to counter the problem. The CEO suggested that technology might make it easier for criminals to sell their ill-gotten products, making shrinkage, or shrink, the industry term for merchandise lost to theft, a bigger problem. Now, this is hilarious and a little bit sad. There's a lot of reasons for this, but if you are not aware, there is a huge increase in shoplifting right now in America. And there's a lot of reasons for this, but one of the reasons, check out Prop 47, which basically decreased the criminality, the severity of punishments for shoplifters, and it's become so prevalent that a lot of cases aren't even being pursued, so people can just go out and shoplift. But also, there's the term organized crime here being used, and on the surface, that is hilarious, because, you know, it's not like the mob is like turning away from a life of importing cocaine and selling cocaine or heroin or something like that, and they're switching to, you know where the big money is, candy bars, Walgreens, rip them off, sell them on Facebook Marketplace. No, I mean, we're not switching to that. Organized crime, by definition, is just premeditated crime involving more than one person. So here, I'm gonna go ahead, become Walrus the crime boss. All right, Scott, Dave, we're gonna go rip off Walmart this week. Dave and I are gonna go in the store. Dave's gonna go over to electronics, swipe some stuff off the shelf. I'm gonna go over to shoes, grab some new Jordans. We're gonna meet up front. Scott, be at the front door in the car in 5 minutes when I text you. There we go. I've just created organized crime. You got 2 people inside and a driver. I'm a crime boss, here we go. And the CEO's comments about technology may seem a little bit like something an old person would say, and it kind of is, but at the same time, it's also legitimate. You know, you can post something on Craigslist or on Facebook Marketplace and get a whole lot of attention very quickly without having to prove the legitimacy of the item or how you obtained it. So it's very easy to resell these things and make a business. Next news story, Cathie Wood and ARK came out with a projection about 2 weeks ago that Tesla was worth about $3,000 per share in their valuation, which, would make Tesla the biggest company on planet Earth. And this week, Elon Musk said Tesla really could be worth $3,000 a share if they execute really well. Musk told employees he agrees with ARK Invest that Tesla's worth $3,000 a share. This contradicted the 2020 remark when Tesla stock was reaching new highs and Musk told his millions of followers on Twitter that he thought the stock was too high. Now, for that $3,000 valuation, ARK Invest believes Tesla is going to be delivering 5 to 10 million vehicles as soon as 2025, and the firm's also betting on Tesla delivering a completely autonomous ride-hailing network known as Tesla Network. It's going to bring in a lot of money on high margin. This just in, company CEO agrees with top-end company share price predictions on blue sky expectations, saying they can do it. I mean, this is kind of a non-story. You're asking a CEO if he's going to agree with some professional investing firm's valuation of his company. If it's a positive valuation, he's incentivized to say he agrees with it. It brings him more positive press. The surprising move from Musk came back in 2020 when he said Tesla was overvalued. This is not surprising. This is just good common sense from a CEO. In media, if somebody throws a question to you like this and they phrase it like, do you think that your company is worth $3,000 a share like ARK Invest said? What are you going to do as a CEO? Say no? Of course you say yes. That's a softball. That's like a PR dream where somebody does all the work for you. They say the stupid thing and you're just like, yeah, no, we can do that if we execute well. Musk did the right thing here agreeing with this, but the fact that he said it means absolutely nothing. Corruption and politics go hand in hand. I've been doing a lot of thinking lately about Congress and Senate and their investments and their disclosures and blah, blah, blah. This is sort of related. This is the Fed presidents disclosing their investments. So Fed presidents Kaplan and Rosengren to sell individual stock holdings to address ethics concerns. Federal Reserve presidents Robert Kaplan and Eric Rosengren said Thursday they will sell their individual stock holdings amid ethic concerns regarding trading in 2020. The Fed officials will sell their stocks by September 30th and put the proceeds in passive investments, they said in statements released Thursday. Oh yes, fantastic. If you're not aware, there was a lot of controversy here about investments these two individuals made on the COVID crash before the US started printing money. And it is very likely that these two Fed presidents were aware that the Fed was going to be authorized creation of new capital to combat the sinking stock market, increase investor confidence, and help the economy. So what's different between insider trading at a company and the Fed doing this when they knew there was going to be money printing? The fact that they're effectively selling their stock at what could very well be a top here this month before we have a little bit of a retracement, which is personally just something I believe. And obviously if they're selling theirs now, finally, maybe they believe it too. Come on, they bought at the bottom, they're selling at the top, and this is supposed to be some benevolent act? Just look at this. It's like Robert Kaplan is extending his hand, asking you, trust me, I have your best interests at heart. And actually, what's with this hand? Doesn't it look like disproportionately tiny to his head? And it should be a little larger because it's closer to the camera. Also, it looks completely disembodied. You know what this makes me think of?
Help! Help!
Here. Oh, take my hand.
Ah!
Come on.
Take Kaplan's hand.
Take my hand.
No, give me your other hand.
Oh, my other hand isn't strong enough. You take my little hand.
No!
Trust the Fed.
Take it. Take my.
Trust the government. Anyway, more news about the government just virtue signaling. Democrats propose 2% tax on stock buybacks to offset their $3.5 trillion budget plan. Senators Sherrod Brown, Democrat Ohio, and Ron Wyden, Democrat Oregon, proposed a bill Friday to levy a new tax on the booming market for corporate stock buybacks, putting yet another target on Wall Street as Democrats propose a slew of new tax measures to help shore up funds for a $3.5 trillion budget bill facing tough opposition from lawmakers on both sides of the aisle. The funds that they're looking for amount to $3.5 trillion. This is just one measure, but still, this is kind of funny. So the proposal, called the Stock Buyback Accountability Act, nice name, would levy a 2% excise tax on the amount corporations spend to buy their own stock. Okay, so 2% increase. So what's the total here? In a Monday note to clients, Goldman Sachs analysts estimated the US companies are on track to buy back about $800 billion of their own stock this year, suggesting the proposed excise tax could be about $16 billion annually. Well, let's go ahead and see if that math checks out. We'll take 0.02 and multiply it by $800 billion. Okay, we've got 16 billion. Math checks out. The only problem is that the budget increase was for $3.5 trillion. Okay. So this is going to amount to 0.45, rounded up to 46%. We did it, guys! We found 0.46% of the money that we need for the $3.5 trillion program. We won! Yay! Seriously, like, the overall prevailing public sentiment right now is that companies are evil. Corporations are evil. Big corporations are evil-er. And what type of corporations are the ones that execute stock buybacks? Typically, it's going to be large, mature companies purchasing back their stocks because they can't effectively use their capital otherwise. So they go ahead and buy back their stock and return value to shareholders in that way. We're going to be taxing that about 2%, which effectively does nothing to offset the price of the $3.5 trillion plan, except virtue signaling. Yes, this is the definition of virtue signaling, where the senators are effectively doing something that's completely meaningless to win over the support of their constituents in their areas. Look at this, guys. We're taking on the evil corporations. We're going to tax them 2%, and it's going to help pay for this $3.5 trillion plan that we're giving back to you guys. Steal from the rich, give to the poor. Oh, how generous. It's amazing. Please. I have an idea. How about we tax all of the Congress people and all of the senators for every single trade that they make while they're in office? That might actually turn up more money. Last week, I covered China's Evergrande situation, the largest real estate developer in the world, and how they were warning in their last earnings report that they might be facing a liquidity issue. This week was the follow-up. China Evergrande bonds suspended as prices plunged. The bonds, which the company was selling off for collateral, were suspended from trading that Friday. They slid another 25% on Monday. There was a freeze on the trading, and then they fell another 35%. I mean, this is a huge decline. The slump in the bond prices came after the ratings downgrade erased the bond's value for their use in pledged repo trading. Their governing bodies that manage the credit ratings for the company, the collateral needs to be rated AAA, while issuers must have credit ratings of AA or higher. Evergrande and its onshore bonds were downgraded to AA from AAA, which wiped off a whole lot of value of the bonds. This really shouldn't be surprising. This is the logical next step. If a company warns that it's going to be facing liquidity issues, chances are a company that's evaluating its credit is going to be taking a look at the same numbers the company is reporting and say, oh, hey, you don't have enough money to pay your debt, and there's a risk of default, which is going to lower the credit rating of the company. So this is nobody's surprise, but I mean, I guess I was a little shocked because of the amounts that the bond value fell. I mean, we're talking over 60% here, but I also didn't understand or know the Chinese law that said those bonds had to be rated AAA to hold their value, and the fact that they went down to AA just killed them. They're worth nothing. So this is a really scary situation here for Evergrande, because they went from having a liquidity issue to now they're losing the chance to sell their bonds as collateral to raise cash. So this looks pretty bad. This looks worse than it did last week when I talked about it. So this is a situation that I think we're going to have to keep an eye on. In other Chinese news, China is going to be pushing on with opening capital markets to foreign investors, because after that Evergrande news, don't you also want to invest in China right now? China will further open its capital markets to foreign investors, the company's top securities regulator said Monday, adding it will pursue pragmatic cross-border cooperation to regulate overseas listed Chinese companies. Global investors have been spooked in recent months by Chinese regulations. Opening up and cooperating, it's the inevitable trend with the integrated development of global capital markets. China is studying further measures, including expanding the scope of the Stock Connect scheme, linking China and Hong Kong, and improving the Shanghai-London Stock Connect program. Yi said that given the interwoven global markets, governments should abandon the mentality of a zero-sum game as companies and investors share both the boom and the doom. And he went on to talk about how cross-border financing should be increased, which really kind of adds to the flavor that they really do want an influx of foreign dollars coming into China. And again, this is almost verbatim something that I said 2 or 3 weeks ago when I was talking about buying the dip in China, and how China still wants foreign dollars coming into the country, and they're not going to completely blow up their own stock market because they need the funds, they need the liquidity. So it looks like I'm right, and it looks like the Chinese government is taking steps to let people know, oh guys, no, seriously, still, we want your money. Please invest in our shell companies right now. In other news, Apple can no longer force developers to use in-app purchasing, judge rules in the Epic Games case. Darn. Apple loses out on monopolistic practices. What a shame. The company that has all of its devices interconnected on one ecosystem, and you can only take your devices to authorized, approved support centers for service. Oh, my heart is bleeding for Apple. I can't believe they lost this case. Federal Judge Yvonne Gonzalez-Rogers on Friday handed out a decision in a closely watched trial between Apple and Epic Games. Rogers issued an injunction that said Apple will no longer be allowed to prohibit developers from providing links or other communications that direct users away from Apple's in-app purchasing. Rogers said that Apple was not a monopolist and success is not illegal. So their App Store business received a major blow. Apple typically makes a 15 to 30% cut of growth sales from its in-app purchasing. That's absolutely bonkers to me. Apple App Store sales grossed an estimated of $64 billion in 2020. This led to a 3% drop in their stock price. Now, to be clear, Apple did win on 9 of the 10 counts, but it was found to engage in anti-competitive conduct under California law and will be forced to change its App Store policies and loosen its grip over in-app purchases. The injunction will come into effect in December. Now, if we take a look at Apple's stock chart, how they reacted to this, I mean, this is the biggest red candle that we've seen in, well, over a year. I mean, this goes back. This is a really, really long time. This was a big drop on the day. 3% on Apple stock it's a huge drop. I mean, the company's a $2.55 trillion market cap company. But still, you know, we're already hitting oversold and Apple's probably going to end up keeping its march upward. But still, this was definitely a big blow and then a knee-jerk reaction with the sell-off. Apple not being a monopoly really kind of had me wondering, what is the opposite of a monopoly? Is it a polypoly? I'm not going to defend Apple here, but it really does kind of beg the question of how much power Apple and their Apple App Store and the Google Play Store should have for charging developers, directing customers to go through their services for in-app purchases. They are providing the ecosystem, but at the same time, the rates that they're charging are shockingly high to these developers, and it could potentially be slowing the development of these developers. I wonder if something is going to be worked out in the future if this issue does arise again, where Apple and eventually the Google Play Store are eventually going to be slashing their rates and not really pushing their own services as much. I'm not really sure how this is going to play out, but I kind of agree with the court system here on this one, and I think it's a pretty big win for Epic Games, and not just them, but really any other app developers that have in-app purchases. They should be getting more money out of this, which is good for them, and it's going to help some of these smaller developer companies develop. Now, for the next story, this is definitely not one of the biggest stories of the week, but I have a lot of viewers that follow Humanigen, HGEN, and there was a huge news development out of HGEN this week. Now, for anybody who's not aware, Humanigen is a clinical stage biopharmaceutical company that is developing a treatment for cytokine storm responses in viruses like COVID in a drug called Lemzolimab. Lemzolimab is currently in its phase 3 clinical testing now, but Humanigen had applied for emergency use authorization, given the nature of the pandemic, for its drug to be used right now. Unfortunately, the FDA declined Humanigen's emergency use authorization request for Lemzolimab in hospitalized COVID-19 patients, but the FDA has committed to working with Humanigen in the development of Lemzolimab and has invited Humanigen to submit additional data as it becomes available. The NIH's study is expected to provide further data that may support a new EUA request, and Humanigen remains committed to completing regulatory processes underway, seeking market authorization for Lemzolimab to treat these patients. The fallout from this, and this is from the Humanigen website, their CEO said, "We believe the ongoing trial, which has been advanced to enroll up to 500 patients, may provide additional safety and efficacy data sufficient to support our efforts to obtain an EUA to treat COVID-19 patients." Now, if you go to the clinicaltrials.gov website, you could see just updated on September 8th, the recruitment status is up to recruiting instead of recruited, because originally the estimated enrollment for the trial was 400 participants, but as you saw in the PR release there from the company, they're up to 500 participants, so they're adding another 25% onto the study. Now, the estimated primary completion date was December 31st, 2021, but if they're adding another 100 patients onto the study, this is most likely going to be extending into 2022. So why am I talking about this? This is not really a big deal. This is just a single biopharma company getting kind of depressing news from the FDA. Is this really newsworthy? Well, kind of, yes, because of the amount that the stock price dropped. We're actually down here at 688, and you could see this was a 47% drop the day that this news was released. I mean, mean, we would have to go back to June of 2020 to find prices at this level. I am not necessarily a believer in Humanigen. I have not covered them on any DD videos for reasons that are my own. But if you are a believer in Humanigen and you just saw the stock price drop 47% for effectively non-news, just saying that it wasn't going to be granted EUA approval, but that the study is still ongoing and they're even adding patients to make sure that it's statistically significant results, this looks like a buying opportunity for HGEN. I'm not advocating buying this, but if you're inclined to invest in biopharma companies with promising pharmaceuticals in phase 3, investing after a 47% drop, this is a good chance. If you're already invested in HGEN, this is a great chance to average down your cost. I'm not going to be doing anything with this personally. I have enough exposure to biopharma in my portfolio right now, but this is a very interesting opportunity with the price drop. Now, an update on something that I covered last week. I talked about the Sprott Physical Uranium Trust and how they were buying up uranium and how they were buying so much uranium that it was driving the uranium spot prices up, and how the company was already seeking secondary sources to purchase said uranium, and how the fund was about exhausting all of the money that it had filed for purchasing. So I thought the purchasing was going to be slowing down. Guess what? The company ended up filing an amended and restated base shelf prospectus. The amended and restated shelf prospectus increases the amount available under the original shelf prospectus by $1 billion and allows the trust to issue up to $1.3 billion of units in the trust in Canada during the 25-month period, blah, 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 blah. $1 billion! Holy crap, this is huge. Nobody was expecting this. We figured, anybody that was following the uranium situation, that they were going to issue an amended amount and end up purchasing more, but going $1 billion more up to $1.3 billion, they moved the market on uranium by over 30% on the spot price just with $300 million, and now they're going to be doing another $1 billion of purchasing. This is crazy. This is crazy. The company already was buying all of the uranium coming out of the ground, looking for secondary sources, and that was with $300 million, and now they're searching with another $1 billion. This is going to be driving the uranium price crazy. Let's take another look at the uranium spot price. We looked at this last week. On September 3rd, it closed at around $38.70. September 7th, we were up to $40.05. By the close of business on the 10th, we're up to $42.40. This is silly. This is the uranium spot price. It's flying right now, and now there's another $1 billion flowing in to make these purchases. I don't really make bold predictions too often on this channel, but I don't see how, if the uranium spot price has moved up so much since August 17th when Sprott started buying the uranium, that another $1 billion, basically over 3 times the amount that they originally committed to this purchase, isn't going to make uranium fly. I don't see how this isn't going to drive the price. Now, some of you guys might get really savvy and try to play earnings on this uranium situation, and you might look ahead at the earnings calendar and you might see the Uranium Royalty Group, UROY, coming out on Wednesday, September 22nd. The Uranium Royalty Group is a company that runs a passive investment firm that invests into uranium mines. Now, it's based out of Canada, but that's the problem. The PFIC rules are then applied because it is based out of Canada, and I caution anybody from investing into UROY trying to take advantage of this situation. So UROY is a PFIC, a passive foreign investment company, and the rate of taxation on a PFIC investment is about 40%. So if you want to invest in UROY, or if you're thinking that's the way to go, you have to really consider, if you're a US citizen, is investing in the company going to be worth it when you're going to be taxed at a rate of 40%? Not really sure about that one. Also, it's worth noting that if you're actually investing into Sprott itself, because it's a physical trust, it also falls into the PFIC rule. Go with a miner like UUUU, like Denison, like CCJ, or go with one of the ETFs that I talked about last week. I don't really think UROY or Sprott themselves are the best way to play the uranium situation because of the PFIC rule for US investors. Now, if you're outside the US or if you're Canadian, then yeah, consider those. Absolutely. Absolutely. But for US investors, yeah, I would not really go with those two as investment vehicles. I think the 40% tax makes it really unappealing. Now, one of the uranium companies that you could be looking at is CCJ. This is the one that I think is going to be performing the best over the next short term because this is the one that's getting spammed all over StockTwits and Reddit. Now, CCJ, after the filing was announced, the extended filing on Friday, increased another 6.45%. And overall on the week, we opened up the week at 2174. We're up to 2443. This has been a monstrous week for CCJ, and I don't really see it stopping anytime soon. Keep in mind, this was despite a red week overall in the stock market. Lovesac! We talked about them last week. I did a kind of pseudo DD video about it, saying that I thought it was a value play at a buying opportunity. And boy, oh boy, I was right. Their net sales growth was 65%, comparable sales growth of 39%. Net income improved to 8.4 from a negative 1.1 last year on year. Second quarter adjusted EBITDA of 12 million. Across nearly every key operating metric, Lovesac's quarterly results affirm the fundamental efficacy of our disruptive home furnishings model, the competitive advantage of our diversified supply chain, and resulting strong in-stock positions along with growing brand awareness. Our strong second quarter performance marks 14 consecutive quarters of 25% or greater sales growth. And this is what I was talking about in that DD video, how it's like quarter on quarter on quarter on quarter of revenue growth with this company and strong revenue growth as well. Take a look at Lovesac's chart after the earnings. Right before the earnings, we dropped as low as $50. I ended up adding to my position at that point that I opened because I was very confident in my forecast here. And right after the earnings, we ended up shooting up. We hit a high of $70.44 before settling around $67.40, $66.81 aftermarket. And once again, this is despite the red week in the market overall. Let's take a look at the upcoming earnings for this week. Not really much. I mean, NAPCO, Oracle, I covered Volt for an options one last quarter. Again, they should be reporting pretty strong earnings, but the stock price has slumped off since I made that options play, ended up selling out, closing out of my position long time ago. So I actually didn't even realize that it dropped off, but it has. Could be another opportunity, but I'm not really taking the chance. You've got C-Chains on here, which is like a super garbage penny stock. I don't know why they're listed on this, but yet there's nothing on Thursday for some of the other small caps, micro caps that are reporting. I don't know, there's just not really a whole lot reporting. Weber Grills are reporting. It should be a really strong earnings coming off the summer season, but then again, I would imagine everybody would expect Weber to have strong earnings after the grilling season ends, so I don't know. We've got High Tide, which is one of the marijuana companies that I kind of like, reporting. Fuel Cell Energy is reporting. I take every opportunity that I can to once again mention that Fuel Cell is an incredibly overvalued company, even after the share price decline. And on Friday before open, I saw this symbol, and I can't believe I never realized this because, on these graphics, if you blow it up, it's just a blurry red and yellow thing, but I recognized the symbol and I looked it up, and guess what? MANU! Oh my gosh. And this isn't like some other company sharing the name. It's literally Manchester United. You can buy stock in Manchester United. You can buy stock in the football team. I didn't know this. By the way, I did just say football for the benefit of all of my international community. Sorry, Americans. But you can buy stock in the football team. You can actually buy stock in ManU. I totally didn't know this. And they generate a lot of their revenue through marketing, through ticket sales, through merchandise sales globally. And the company's pretty strong financially. I didn't know any of this. Here's the ManU chart. We've been increasing since July. We ended up hitting a high of $19.15, currently sitting at $17. ManU's market cap is almost $3 billion, $2.82 billion. Price to book's pretty low of 5. This is pretty cool. And if you look at their financials, revenue up and down, probably fits with the season. And the net income, it's not great. Last quarter, they lost a bunch of money. Quarter before that, they made a bunch of money. Quarter before that, they lost a bunch of money, up and down, whatever. I'm not going to invest into it. But it was still interesting nonetheless seeing ManU on the earnings reports. All right, guys, that's it for me today. Like I said, I'll try to put out some more content later this week. I do hope you guys enjoy this video, but please, if I don't get to anything else, that means I'm having a rough go after the COVID vaccine. Please don't kill me. I'll try to get back at it as soon as I can. Thank you always for your support. If you're interested in further supporting the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Webull runs some fantastic promotions all the time. Also, if you enjoyed the video today, please like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Happy investing. Have a good week. I'll see you next time.